Hello and welcome to This is Property with Rachel and John. Looking forward to this recording, Rachel, because plenty of juicy questions for us to answer today.
There are.
We're talking about debt recycling today, which is a really interesting one, isn't it?
It is.
It's bandied around a lot, and some people come to me and say, what the hell is debt recycling? So we'll go into that in detail, but also talk about the ways that you need to manage it, because the structure thing is really important, isn't it?
It is. It is important. And so is your accountant's advice.
Absolutely. And that can be mixed. I'm on to my third accountant in the last 30 years. So
really?
Yeah, absolutely. You've got to keep them honest in this world. Any case, let's get on with the show.
All right, so straight into questions and answers. Matthew asked, paying for renovations, pros and cons to refinancing following a valuation based on future value after renovations versus cash flow versus any other way people pay for renovations.
Yeah, so as we know, and you're in this world every day, the valuation system, you can, I suppose, manipulate, can't you, to your benefit?
Well, you can. You can definitely get options.
So we always say, let's get 3 valuations done.
Yeah.
It's like, okay, let's get 3 valuations regardless of whether we've done a reno or not. Let's get 3 because the extremes of valuations and opinions on these valuations can vary so much. Like I had one was $150K difference from one value to another. Like I'm going to that value every day of the week.
Yeah,
and whether that lender,
and whether you're renovating or whether you're looking to invest or whether you're looking to get, I guess, or while the market's great, getting some cash out now, knowing that you can use it later. The valuations are so important, and like you said, the 3 will make sure your valuer is fair.
So I think it comes back to things in your control versus out of your control. What can you control? Well, I can control getting cash out now. I've got it at my disposal to go and spend or do whatever I want to, whether that be renovation or what. But also the renovation that we may undertake, right? We can, and people use the word or 2 words, don't know if it's joined or not, overcapitalise.
Yeah.
Right? So
I did that.
Did you?
At my own occupied, absolutely.
Yeah.
But I'm living in it. I'm not trying to make money on that.
Okay, so in your eyes, because that's a good point, is in your eyes you may have overcapitalised, but in the market's eyes, you haven't gone and spent $1 million too much for where the market is. An example of that is my property's worth $1 million. I put $1 million reno into it, so now it should be worth $2 million, but the highest price in that suburb comparable is 1.5.
Yeah, and coming back to Matthew's example, if you're looking at a house and you're looking at maybe doing a $150,000 renovation, the valuer each way will say whether that valuation you're doing is actually going to add $150,000 value to your home.
Yeah.
Now, when I said I overcapitalised on my own home, the renovation I didn't add that much value if I was going to sell it, but I didn't do that renovation to realise a gain. I did it because I wanted my family to have the beautiful things that I put in it.
Really? You didn't think about wealth creation?
I didn't for once.
This is amazing. So, again, talking renovations, ideally when you spend $1, you want to get 2 or 3 back from that in terms of the value. So that's just something as a maybe a guide. You don't want to spend $1 to get $1.
Yeah. And so we're looking at how you're actually going to get your cash to do a renovation. If you go and see your broker and get a valuation of your property now or 3 valuations, you can see whether you can get the equity to do the renovation out now. So if you've got the equity and the income to get that cash out for your renovation, that's the easiest and most simple way to do it. But if you're doing a major renovation and let's say you don't have the equity now with those valuations, you might need to get what you're saying like a to be completed valuation, and that's very different. That's when the valuer comes out and says, if you put this kitchen and bathroom in, it will be worth this, and then you can borrow, the bank will lend it to you on that value. Yeah,
which is really strong advice to do that, isn't it? You need to look at, well, what will it look like and what are comparables in the street that have a similar finish to what I'm about to do.
Yeah, and then the other way people would fund renovations would be just their savings.
Yeah, that's right. So do we want to use our savings when it's for our owner-occupier? Well, 6 to 1, half a dozen the other. If we borrow the money, we've got a debt and we want to pay down that debt, so we might as well use our cash, but we don't want to go too I suppose, cash tight to the point that we haven't got enough buffers and we're not sleeping at night.
Yeah, that's right. And I mean, the renovations that you're doing, it's like with what we don't know, the answer to this question is what are the reason for your renovations? Are they to sell the property, which is that, or is it an investment property? It'd be a very different strategy than are you doing it because you want a lovely new kitchen?
Yeah, absolutely. And if it's owner-occ, generally it's what you did, like I want to make this a beautiful home for me and my family.
Yeah.
But it may be to upgrade as well. So, okay, I want to get the best bang for my buck, upgrade it, which means I've added value to the property. It's worth more. Now I can take those funds and buy a better asset.
Yeah, excellent.
One thing I would recommend, and I'm not sure, I know Matthew won't do this. I was renovating a property. Right, these hands don't do too much renovation, but general cosmetic stuff. And the valuer came because I'd ordered a valuation on the basis that our renovation was complete.
Yes.
Right. The valuer came a day early.
Oh.
And the front door was literally off because I was painting it.
Oh, no.
Guess what happened?
He put that in. He gave you a knock.
Yeah. It's got no door on it. We're valuing it with no door. I'm like, dude, the door will be back on tonight.
Oh, wow.
Sorry. So, yeah. Haven't seen that happen again. Maybe there was just me.
And that is a tip. I think it does. I think presentation matters when the valuer's coming.
Yeah.
So, pop the scones out.
Yeah, pop the scones out. Yeah, well, I didn't have time to make scones. I couldn't even get a door on. So, in any case.
Lindsay asks, if everyone in Australia who had 2 or more investment properties were forced to sell them immediately, how many more homes would be added to the property market for sale? I don't know if there's a way to find that out or it's just something that came to mind. So Lindsay's asking if everyone in Australia had 2 or more investment properties, had to sell them immediately. So if the government came and said, okay, if you have more than 2 investment properties, you had to sell, would that solve the Australian housing crisis?
On one hand, it helps. On the other hand, it doesn't.
Okay.
Right. So let's think about this. When we buy investment properties, what are we doing? We're renting them out.
Yeah, we're providing housing.
Housing for people.
Yeah.
Right. So if everyone in Australia sells their investment properties, guess what? No one can rent. There's homelessness like you wouldn't believe.
Yeah.
So that's a widespread problem that's not going to go away, right? So that's catastrophic, isn't it?
It is.
And that's way worse than the alternative or the selling of the properties to then create more stock to not have the property market being so expensive.
Yeah.
Right. I'm on the side of, well, we've got to keep these properties for people to be able to rent. Because government housing there's not enough to be able to live for renters or tenants around the country.
And that is the fact. There is not enough housing and we cannot keep up with the demand for housing.
Yeah.
I would hate to see what would happen to the economy if everybody was forced to sell their properties. I'm sure that they've considered it. I mean, they wouldn't even take away negative gearing for the fear of what it would do to the housing market and allowing those things. But interesting concept.
It is, yeah. And hot off the press, negative gearing, I believe, has been taken off the table for next election promises. So, yeah, once again, been on and off the table quite a bit. But I think when we look at Australian property, right, there's around about 5% of the total amount of properties are sold each year.
Okay.
Right. So something like 11 million properties in Australia, but only 500,000 are transacted on each year.
Okay.
Okay. So don't ask me where I got that stat from, but it's pretty reliable. So when we think about investors that own 2 or more properties, we're talking like 2%, a really small percentage. Right. So it's going to have some impact, but it's going to be a dent. It's not going to be a full-on crash, I don't think.
Yeah, I think those people that have 3 or more investment properties, what do they equal? Is it 1% of
yeah,
investors?
1 point something percent or something.
And so I think when people do, I see a lot on different chats about that's the thing causing the housing crisis. However, there's such a tiny percent. So could that be such a big impact that people think?
Yeah, absolutely. I think it's the poor old investor, they cop it when there's any policy change or property prices too high or rents are too high or whatever it may be. Well, it's just a fact. It's a byproduct of what the government's created, basically.
Yeah, and we need to find ways to help first home buyers into the market.
Yeah, no doubt about that. Absolutely. And when I talk about that 5% of properties transacted each year, what are the other 95% doing?
Yeah.
It's a story for another day.
So Gemma asks, if you have an investment property loan where not all tax deductible because you took cash out to buy a PPOR, is there any way to make the interest fully tax deductible again? Or if not, can you split the loan and try to pay down the non-tax deductible part?
Good question for an accountant, this one.
It is a good question for an accountant.
We'll have a go at it.
Or, Gemma, with loans, and this is why your accountant, when you do get different loans for different purposes, would tell you to have different splits. So, you might have your split for against your PPOR that is investment. You might have a split that's for shares. You might have a split that's for a deposit and cost for an investment property. It's about the purpose of the loan that means whether they're tax deductible or not. So, can you do those things? Yes, you can. But would it be fully tax deductible again? In my opinion, it would not be, but you'd need to go to your accountant and find that out.
Yeah. You mentioned the word purpose. What's it being used for?
Yeah.
If I'm using it to buy a boat, right, that boat's not income producing. It's a toy for my lifestyle, not tax deductible.
Yeah.
Right, by the definition of the ATO. Whereas if I'm taking some equity from my home and I'm going to use that as a deposit and costs for buying an investment property, which is income producing, and I'm not living in it, then tax deductible.
Yeah.
Is the black and white essentially, isn't it?
Yeah. So, Gemma, if that portion was for your owner occupied and you refinanced it and just took it up to that level, your accountant may say that's not tax deductible because the purpose of that was to buy your owner-occupied property.
And one of the most common questions we get, both with clients and people that reach out on clarity calls, is, do you have a good accountant?
Yeah.
I don't know. I reckon it's 1 in 2 reach out and say, oh, by the way, do you have an accountant? Because either mine's retired, too old, or they've left, or I don't know. But I suppose back to my point before about being on my third accountant. It's not because I'm I suppose want to continually change experts. We don't. We want trusted people in our corner for the next 30 years. And there's good and bad of everything out there. So just continue to ask good questions.
Yeah, that's right. I've only had the one accountant, but he's very conservative. But sometimes I have to push and I have to say, can you just see if that is possible? Can you ask? Can you double check that? But I do like to be on the side of being cautious with accountants. Yeah.
Yeah, and I think there's a lot of grey area, isn't there?
There is.
And when there's grey, it's interpretation now, isn't it? So.
Yeah. So, Gemma, check with your accountant and your mortgage broker will do whatever you ask them to do.
Because they're the one taking the risk when you sign off on it as an individual. I reckon we'll take a break and then we'll come back with Jacinta's banging question.
Amazing.
This is Property is brought to you by Sphere Home Loans. Sphere Home Loans is a mortgage broker that helps our listeners all around Australia. So, if you want to get into your first home sooner, looking at upgrading, an additional property, or want your current mortgage reviewed, just search Sphere Home Loans or click the link in the show notes, and their dedicated brokers will be able to help you wherever you are. If you are, however, after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to moneypodcast.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. That's moneypodcast.com.au and click Get Help.
Jacinta, what's Jacinta got for us?
Jacinta asks, pulling out equity in your current investment property to purchase a second and grow portfolio. How much is good to take? What percentage of income do we really want to be putting in to hold an investment? Currently, our investment property is positively geared, but if we want to expand and buy a second, we'll have to put in a couple of $100s each week to hold them. I see this sort of scenario every day at the moment.
Every day, bar Sunday, don't you? Yeah. So I think there's a few aspects to answering this question. The first one is, what's your strategy overall, right? Do you want a positive cash flow portfolio? Do you want capital growth? Do you want your cake and eat it? Do you want some tax benefits? What do you need? So I think we need to answer that first as an individual. But yeah, so holding costs are less than what they were 12 months ago.
Yeah.
Because interest rates are lower. We need the bank's money to be able to buy that second property. We want to get equity out of our portfolio. We've got a positive cash flow property number one. We are going to take on more debt and use 100% of the bank's money and more because of stamps and costs, etc. So we could assume that if we're going to buy a really good asset that's going to perform for us long term, that it's going to be probably negatively geared in some way, shape or form if your purchase price is probably 600 plus.
Yeah.
If we're buying 400K real estate somewhere around the country, again, we could probably get a positive cash flow property,
Really?
I reckon,
Okay.
if we searched hard enough. But once we get up into 5, 6, 7, 800K territory, we're going to be negatively geared
Yeah.
using 105% of the bank's money.
Yeah. And so when Jacinta asks what percentage of her income would be wise to put on hold for an investment, I think the answer of that is what you're comfortable with in your budget. And I think you really need to do your own budget and go, well, how does this look now? You know, what's my living expenses for my personal life? You've got an investment property that's, you know, neutral, so that's paying for itself.
Yes.
Do you have that $200 free a week, if that's what it's going to cost, to hold that next investment property? Will that make your life uncomfortable, or is that something that you can do?
Yeah, and a lot of people say, well, my emergency buffer in my personal life is 3 months worth of cost to exist, for example.
Yeah.
There's no science to it when it comes to each individual property, is it? Because the yield on each property is very different and the lending structure is very different, i.e. if we've got cash versus equity as our deposit. So to say what are my holding costs going to be, we don't really know until we start searching once we've designed our strategy. So once we've got that, then we can forecast, yep, it's $200 a week. Right, I'm putting that aside and then I'm comfortable. I've factored in repairs and maintenance of vacancy rates, maybe an interest rate rise, etc.
Yeah, and obviously every rate decrease that we get is obviously taking there's less cost to hold. And people that have budgeted for that when the rates were low had those really big cash buffers. They used a lot of those cash buffers while rates were high, but hopefully now their portfolios are coming back to a little more close to neutral.
Yeah, absolutely. The other thing that we've spoken about a little bit, Rach, is when we're pulling out some equity from a property, can we grab a little bit more as a buffer that we may not use, but we've got it there as a safety button?
Yeah, and we can. And if the equity's there or the income's there, it's really important to note that you can borrow money in an interest-only environment and not pay for that money. You can have that money sitting there as a buffer. And I think the more people do grow their portfolios, you really need to have those funds there.
Yeah.
And especially if things do change in the market, and we've just seen this, you know, when the rates went up, a lot of the people who had those buffers maybe needed to use some of those while rates were high. Now they're coming back. I know that I'm getting those calls saying, oh, I need to save those buffers again.
Yeah. You just need to have levers to pull, don't you?
Yeah. So I don't think there's an exact answer to that, but I do think it's worth, if you've got a positively geared property, just do the numbers and see what's comfortable for you. Buy a second.
Go get it. Steph. Rach, this one is for you, she says.
Okay.
A lot of people chat about debt recycling, but don't cover off on what happens if you need to sell that property to upsize.
Okay, yeah.
I know you aren't a financial advisor, but from a mortgage broker perspective, could you provide guidance on whether you can transfer all of these split loans to your new principal place of residence when you move homes? Or do you need to basically start your debt recycling strategy from scratch if you sell the home?
Yeah,
That'd be unfortunate, wouldn't it?
You emailed this one to me when it came through, and I know what answer that I think I have on this,
Okay.
and I've done this too, because you've got to think we all do it. I've got my owner occupied, and I've got several splits against that. One's for my home loan.
Yes.
And then there's a few different splits that are for investments.
So just to confirm for the first-time listeners, the splits you're referring to as I've got some equity out and I've used that amount as a deposit for
another property. So you might call that, investment split 1 on your internet banking, and you might have another property over here. And when at the end of the year, when you do your tax return and your accountant says, okay, what's the interest that's tax deductible for that investment property? It's the split that you've got against your own home that you borrowed for the deposit and costs, and then the other split that you borrowed against that property. You add those two together. So a lot of people do have investment splits against their own home. But that question's really interesting because what happens when you sell that house and you move? You're closing down those loans and then reopening. Is the purpose still investment or is it now to buy a property? Now, I've done this before where I do have documented what those purposes were, closed the loan off, opened it up again with those splits still there to say that's for investment purpose.
Okay.
But before answering this question, I really wanted to ask an accountant, which I would always recommend you do. So I think anyone who has this scenario should ask their accountant. I asked 2 accountants and got 2 different answers.
Ooh, juicy.
I know. So one accountant said to me, unless you are doing a substitution of security, so you're actually moving all of those loans directly from one property to another and the loans technically never closed, then it's not tax deductible again against the next property. This accountant said once that loan's been closed down, the purpose of the new loan is to buy an owner-occupied home, therefore not tax deductible. I didn't like that answer, so I asked another accountant. And the next accountant said, as long as you document what those things are for, the ATO looks at purpose. So that loan 1, document what it was, and then when you move to the next property, you say that loan is for this, that loan is for this, and when you're audited, you do that.
Yeah.
So my advice would be to ask your accountant, but when I sold and bought my own occupied, I kept those splits as tax deductible for properties.
Yeah. Getting into the weeds of that a little bit, would it matter if we're changing banks there? Like say I'm with, I don't know, Westpac, and I'm selling that property, paying down all my debts, and then I'm buying a new home using Westpac as well. Would that, because I've got some history there and they can see what's happened, would that make the process a little easier
I
or
don't
not?
think that would make any difference because one loan's closing and one loan's opening. So the fundamental difference is what's the purpose?
Yeah.
And the difference in the answer from both of these accounts is one said, once the loan's closed, the purpose has changed. And the other said, well, the purpose is still the same as long as it's documented. So whether it was Westpac to Commonwealth Bank, that wouldn't make any difference.
But if you went to Commonwealth Bank, would you create that third split like you had initially?
Yeah, so it's really important that you still have the same amount.
Yes.
You can't just make it bigger.
Make a figure up.
You've got to same amount and say document I closed this loan at this property and went to this property.
Yes.
But I do think that you need to ask your accountant and also have their answer documented to show that you did the right thing.
Yeah. Yeah, documentation is key, isn't it? Especially for the ATO.
What would you think the answer would be to that? How would you answer that?
When I get a no answer, I just try and find a yes somewhere. I'm with you, but it's because and we're chatting off air about this a little bit. Like taxation's so grey, isn't it? Like there's no black and white, or very rarely black and white. So when it's grey, it's very much open to interpretation.
It is,
and if you can see that you're not actually trying to be deceitful or trying to hide something or whatever, then generally it's okay.
Well, that's the thing. The truth of the matter is, in Steph's scenario, that split was for shares.
Yeah.
She'd debt recycled. She'd created a split for the right purpose. It was for investment. She's still got those shares.
Yeah.
She's still got those loans for that purpose.
Nothing's changed on that side of things, yeah. Just to roll back a step on just to clarify for people, for listeners out there that when you have taken equity and you sell the property in which the equity has come from, you have to pay out that equity loan, right? Because I think there's a little bit of, oh, really? Do I have to pay that? But I've got that for that next property. No, but it's come from the initial property. So just take that in mind because people come and say, oh, look, I've got $500K when I sell this property. Well, no, you haven't, because you've taken 150 of it and used to go and buy an investment over here, right? So you've actually only got 350 because you have to pay that 150 back.
You do. So it's always good to see what those loans are secured against, and get your broker to do up a mud map for you. Get a little diagram of what's secured against what, or if you've done your loans with a bank, get them to tell you what's secured against what, and to have a little mud map file somewhere.
Yeah, absolutely. No, good call. Alrighty.
Tom asks, our Commbank account has a home hub that shows estimated house value with a low, medium and high range.
Yes.
This is followed by an estimated total equity. Is this any different to what a CoreLogic valuation would provide, and how accurate do you think it would be?
Tom, I've got the same feature. Yeah. Now, I've often checked this against my RP data and seeing, and sometimes it's accurate, sometimes it's not, right? And we spoke about valuations before. It's basically desktop, isn't it?
Yeah.
Comparing it against something else in the street that's same bedrooms, same size land, whatever. So it's a starting point, but I think it's a grain of salt. It's looking at it and say, okay, that's a starting point, but now let's dig into the weeds and get ourselves a valuation, a proper valuation.
A proper valuation.
Yeah. I'm just trying to find this hub that he's referring to, but mine obviously not coming up. But in any case, yeah, that's that would be my thoughts. What about you?
Yeah. Look, I think the Commbank one's pretty good.
Yeah.
They are pretty
As in accurate?
Accurate, but it can also be sometimes a little higher than the others too, which sometimes we like to use because a lot of the time the bank will accept that valuation too. So sometimes there's a full valuation done and that particular feature comes in a little bit higher, and we use that to fund investment properties. But you just can't say, would my house sell for that?
No.
It's not you wouldn't, if you're using it for a valuation for what your strategy is, great, but would you take that as gospel of what your house would sell for if you had to? Maybe not.
Yeah.
Because sometimes they are high.
Yeah, and people can get quite excited by that.
They
it's
can.
Like, oh, wow, I didn't think it was that much. Well, you get a proper valuation, it may not be.
Yeah, so you can and you can go in, those CoreLogic valuations are great as well because they show the comparable sales.
Yes.
And you can have a look. You might know better than CoreLogic. When it puts those comparable sales in, you've seen the houses that have sold around your property.
Yeah.
You know if it's inferior or superior to your home generally if you've sort of checked out the market. So I'd have a look on the comparables that they're using. And if the comparable that sold a month ago that's inferior to your house that sold for more, then you probably would get those funds.
Yeah, that's right. And especially if you're in a suburb where there have been very little sales.
Yeah.
And the properties, the photos and everything haven't been updated. Like mine hasn't been updated, for example.
Yeah,
so
okay.
Mine's showing like a 20% increase in the last 5 years, right?
Wow.
Based on the fact that A, no sales, and B, the dwelling is like it was 5 years ago when I bought it. So it's a, as we say, it's desktop, it's online, it's someone sitting in an office in Sydney, Melbourne or Bangkok. It's really getting on the ground and getting someone through it to make sure you maximise that.
Yeah, I actually had a strategy meeting with a podcast listener this week, and they had a property that one had bought themselves and the other had bought the other. So they had a property each when they've come together.
Yeah.
And they were buying a property to live in, and they wanted to keep these two as investment.
Yes.
And they had estimated the valuations of the two properties they held. I think one was in Sydney and one was on the Central Coast, and they wanted to buy another. And the estimates they gave me, I thought, oh, that's great, we can probably do it, but we're really tight. The valuations for both of those properties one came in $50,000 more and one came in about $90,000 more. Yeah. So what they could buy was very different when the real valuations actually came back. Music
to your ears, yeah. And probably as a reminder to everyone, if you have got property right now and you are in quite a buoyant market, great time to get a valuation done get some equity out, isn't it?
That's right. And don't just think you know what that property's worth when you're doing those numbers.
Yeah.
Get a valuation done. Your broker will do that for you anytime.
Yeah. Education's power.
Yeah.
All right. One we picked up yesterday, Rach, that I wouldn't mind running past you.
We have time for one more.
We've got one more up our sleeve. Samantha says, my partner and I have 4 mortgages between us. Our PPR, principal place of residence, and 1 investment property together, then each have an IP from prior.
Okay.
All right, so you might have to jot a few of these things down.
I'm going to jot that down.
All the IPs are cash positive, with mortgages being principal and interest, which is outstanding. I'm thinking, okay, all the running costs, the principal and the interest taken into account, we're still cash positive.
Yep. Great.
Great outcome.
And have they got an owner occupied? Sorry, I'll let you finish.
Yes. We've got an owner occupier. So our PPR has the largest mortgage. Yeah? You see where we're going with this?
Yeah.
My question is, do we just leave the mortgage as is and continue to let them pay for themselves eventually, owning the houses outright from the rental income? Or change the loans to be interest only on the IPs and use that extra money to smash down the mortgage on our PPR? We have advice that goes both ways. That's unusual. So just curious how others would view or justify each choice.
Yeah, well, I'm really surprised you've got advice that goes both ways, because if your biggest debt is your one debt that's not tax deductible, that's your home loan, everything that you have needs to be directed onto that home loan. So you've got 3 investment properties that are cash neutral. That is amazing, by the way. Well done. That's what we were talking about before. What's that percentage-wise in the top 1% of investors already?
Totally. Yeah.
Now, you're paying principal and interest on all 3 of those investment properties, and you're making money on them. So what are you doing with the money that you're making? You're paying tax on that. Okay. And if you continue to pay principal and interest, what's going to happen is that debt will continue to decrease, but your rent will continue to increase. So the tax that you pay will increase while you've got this mortgage that's not getting smashed down. So if I saw this scenario, I would really encourage you to pay principal and interest on your own home, interest only on those 3 investment properties, but you don't want to lose by paying less. So let's not pay any less every month. Let's work out what's the principal and interest repayment that you're paying now, and let's just pick a figure. Let's say it's $3,000 a month that you're paying to have those 3 investment properties, and let's say if you change it to interest only, it would be $2,000 a month. So now your minimum repayment on these 3 investment properties has gone down $1,000 a month. Direct that $1,000 a month to your principal place of residence.
To the offset?
To the loan.
Down.
If that's your, I guess this is psychology. If that's the house that you're going to live in forever and it's never going to be an investment property, smash it straight onto the mortgage or into the offset account if it would possibly be an investment down. But whatever you do, it should be on your home. And get that home loan down and make sure those investments, earmark them for later. You can pay those down after your owner occupied's paid out. What would you do?
So I like that. What if I'm someone that says, I just don't like any debt, good or bad? I know the difference between the two, but I just like to pay down all debts that I've got.
Yeah. And I agree. I also don't like debt. I'd like to have them down as quickly as I can. But would you not want to pay the more effective one first?
Logically, yes. I totally agree with you 100%.
Yeah.
But I come across this quite a bit as well. And it's like, well, it's a no-brainer here.
Yeah.
Like there shouldn't be another side of the argument. Like the argument's over. There is no argument. But it depends on our mindset. It's like, well, I just don't like debt. I just want to pay it all down. And I have that feeling at night that I'm chipping away at all of them.
Yeah.
So I get where people are coming from that sense. But financially speaking, no-brainer. Pay down the bad debt first, get on with your life. The cash flow positive nature of the investments over here, perfect. Like that's great. But as you said, you're paying more tax on them as the rents increase and the fact that your loans are going to continue to decrease.
Yeah. I had an appointment with a client that I've had for about 9 years a few weeks ago, and they bought a property, a house and land package, it might have been 9 years ago, and they didn't build it, but they bought like what would have been in a new estate. And we had that was their first investment property. We had that conversation about interest only. And I remember trying to explain that the rent would go up and everything would go up, and if you just paid interest, he said, but if I just pay interest, I'm still going to owe this much in 10 years' time. Yeah. Well, we caught up 9 years later and he still does owe exactly what he borrowed on that property. But that property is now very positively geared. So he owes about $420,000 on that property that's getting $800 a week in rent now.
Yeah.
Now, if he'd paid that loan down instead of his owner occupied, imagine the tax he'd be paying on that rent.
Yeah.
And he probably wouldn't have paid his home off, which was the most important.
Yeah, that's right.
So
and that
you just
property's
got to
probably doubled
Yeah, and it is a psychology, and it's just because I spoke to that person, it was 9-year difference.
Yeah.
Oh, I still owe that much, but look at what that property's worth now.
Yeah, correct. And there's never going to be a one-size-fits-all in this, and it's never going to be an ideal world either, but you want to get to the finish line, and if the finish line is retirement for you, full-time retirement, fully blown, no more work, right, you get to that stage where you've got positive cash flow properties, you've got no bad debt in your life, and you're getting some sort of income from your property or your shares, or and then obviously draw on your super, and you've got this live life happily. But yeah, I think sometimes you can, if you go down the wrong path, you look back and say, oh, hang on a minute, I could have avoided that. And this is probably one of these moments for Samantha is like, yeah, if you just now focus on your bad debt, okay, the portfolio will look after itself, and you'll limit the damage or the bleed on the tax side of things as well.
It will. Smash that home loan down.
Go do it, Samantha. Good problem to have though.
It
4
is.
properties.
Well done.
Yeah, good stuff. The message I took from that is find someone who's also got properties in their life and join them together and have a big portfolio.
Yeah, very nice portfolio.
Yeah, so there you go. All right, I think that is a wrap for today.
Yeah, thank you for your questions. They've been fantastic.
Awesome. Yeah, keep them coming in the Facebook group or hit us up online. If you enjoy what you're listening to today or any other episode, feel free to share it on to a friend. Give us a little bit of a 5-star. That would be nice, Rach. And I must say, people are wrapped with my new co-host.
Oh, thank you.
Yeah, I'm getting a lot of feedback that says, love listening to Rach as well.
Oh, that's really lovely to hear.
Yeah, so we're on a winner.
Amazing.
All right, until next time.
Bye.
Bye.
Any information given in this podcast is for entertainment purposes only, and you should seek your own property advice before acting on anything you may hear in this podcast. If you want to start or advance your property education journey, John Pidgeon's book, Sort Your Property Out and Build Your Future, is available where all good books are sold, or via the link in the podcast show notes. Opinions or comments from any guests on the podcast are theirs and not those of the hosts, the publisher, or their respective license holders.